The concept of banking, like many pillars of civilization, emerged in the cradle of civilization Mesopotamia. Around 3000 BC, temples in Sumer acted as secure storehouses for grain and valuables. These institutions, backed by the authority of the priesthood, naturally evolved to provide loans and facilitate trade. Neighboring Babylon refined these practices. Babylonian temples, as centers of both religion and commerce, developed sophisticated systems for lending, deposit-taking, and even charging interest. These temples became vital hubs in a burgeoning economy, their activities documented on meticulously maintained clay tablets. Across the ancient world, similar practices emerged. In Egypt, temples played a critical role in managing grain surpluses and financing large-scale public works. Pharaohs wielding immense power also utilized these temple-based systems to finance expeditions and wars. In Greece, temples served as safe havens for deposits and offered loans, often at interest. The development of coinage in Lydia further fueled the growth of banking, with money changers setting up shop in bustling marketplaces. These early financiers facilitated trade and commerce, their activities laying the groundwork for the more complex financial systems of the future. The Roman Republic witnessed a significant evolution in banking. Private individuals, known as argentari, emerged as prominent figures in finance. They operated exchange banks, offered credit, and facilitated transactions, fueling Rome's expanding empire. As the Republic transitioned into an empire, the state began to play a more active role in banking. The mensari, public officials appointed by the Roman Senate, were tasked with managing the public treasury and regulating the currency. They established official exchange rates, supervised the activities of private bankers, and played a crucial role in maintaining financial stability. However, the fall of the Roman Empire in the 5th century AD led to a decline in banking in Western Europe. With the collapse of central authority and widespread economic instability, trust in financial institutions eroded. While some limited banking activities continued in monasteries and amongst Jewish communities, the sophisticated systems of antiquity largely faded away. While Western Europe grappled with the decline of Roman institutions, the Byzantine Empire, heir to the Eastern Roman Empire, kept the flame of banking alive. Constantinople, the empire's capital, boasted a vibrant financial sector. Byzantine bankers facilitated trade, provided credit, and even issued rudimentary forms of letters of credit, facilitating long-distance commerce. Meanwhile, a new force was emerging in the Middle East: Islam. Islamic banking, guided by the Quran's prohibition of riba, usury, developed innovative financial instruments. Mudaraba, a form of profit-sharing partnership, and musharaka, a joint venture where profits and losses are shared, emerged as alternatives to interest-based lending. Islamic banking, with its emphasis on ethical principles and risk-sharing, flourished during the Islamic Golden Age, facilitating trade across vast distances and contributing to a vibrant and interconnected economic sphere. The Italian Renaissance marked a pivotal moment in the history of banking. As trade flourished and cities grew, the demand for sophisticated financial services exploded. In Florence, a powerful family of merchants and bankers, the Medici, rose to prominence. The Medici family, through their network of banks, financed trade, lent to kings and popes, and amassed vast wealth. They innovated new banking practices, including double-entry bookkeeping, which revolutionized accounting and provided greater transparency and accuracy in financial record-keeping. The Medici's influence extended far beyond finance. They were patrons of the arts, supporting artists like Michelangelo and Leonardo da Vinci, and played a pivotal role in shaping the cultural landscape of the Renaissance. Their story exemplifies the growing power of finance in shaping not only economies, but also societies. Section 5. The rise of central banks, stabilizing economies and shaping nations. The rise of nation-states in Europe during the late Renaissance and Enlightenment brought about new challenges and opportunities for banking. Governments, needing funds for wars and expansion, turned to financiers for loans. This interdependence led to the creation of the first central banks. The Bank of England, established in 1694, is considered the first true central bank. Its primary role was to manage the English national debt and ensure a stable currency. Other nations soon followed suit, establishing central banks to regulate the money supply, manage national debts, and act as lenders of last resort to commercial banks. Central banks played a crucial role in financing industrialization and economic expansion in the 18th and 19th centuries. They provided stability and helped to mitigate financial crises, laying the groundwork for modern economic systems. Section 6. The Digital Revolution Transforming Banking in the 21st Century. The late 20th and early 21st centuries have witnessed a dramatic transformation in banking, driven by the relentless pace of technological innovation. The advent of computers, the internet, and mobile devices has revolutionized how we access and manage our finances. Today, online banking, mobile payments, and digital currencies are rapidly replacing traditional banking methods. Financial technology, or fintech, companies are emerging as disruptors, offering innovative solutions for payments, lending, and investment management. This digital revolution is democratizing finance, making it easier and more affordable for people around the world to access financial services. However, it also presents new challenges, including cybersecurity threats, data privacy concerns, and the need for regulatory frameworks to keep pace with rapid technological change. Section 7. A House of Cards, Fractional Reserve Banking and its Discontents. Since the Renaissance, the dominant form of banking practiced globally is fractional reserve banking. This system allows banks to lend out a large portion of their deposits, keeping only a fraction in reserve. While this practice fuels economic growth by increasing the money supply, it's inherently vulnerable to bank runs. When depositors lose confidence in a bank or the financial system as a whole, they may rush to withdraw their funds, leading to a bank run. If too many depositors demand their money simultaneously, even a healthy bank can collapse, triggering a chain reaction throughout the system. The history of banking is replete with examples of bank runs and financial panics, highlighting the inherent instability of fractional reserve banking. The Great Depression of the 1930s, triggered in part by a wave of bank runs in the United States, serves as a stark reminder of the potential consequences of systemic financial fragility. Section 8. Breaking with bullion, the end of the gold standard and its aftermath. For centuries, gold served as the bedrock of the international monetary system. The gold standard, which linked the value of currencies to a fixed quantity of gold, provided stability and predictability in international trade and finance. However, the 20th century witnessed the gradual demise of this system. The pressures of two world wars and the Great Depression forced nations to abandon the gold standard. In 1971, President Richard Nixon severed the final link between the US dollar and gold, ushering in an era of floating exchange rates. The end of the gold standard brought about greater flexibility in monetary policy, allowing central banks to adjust interest rates and manage their currencies to stimulate economic growth and combat inflation. However, it also introduced greater volatility into the global financial system. Section 9. The Future of Finance, Blockchain, Decentralization and Beyond. Today, the world stands on the cusp of another revolution in finance, driven by technologies like blockchain, artificial intelligence, and big data. Blockchain, the technology underpinning cryptocurrencies like Bitcoin, has the potential to disrupt traditional banking by enabling secure, transparent, and decentralized transactions. Decentralized finance, or DeFi, built on blockchain technology, aims to create a more open and accessible financial system, bypassing traditional intermediaries like banks. AI-powered algorithms are being deployed to automate trading, assess creditworthiness, and detect fraud, promising greater efficiency and personalization in financial services. The future of banking is likely to be characterized by greater automation, decentralization, and data-driven decision-making. While these innovations offer tremendous promise, they also pose significant challenges, ranging from regulatory uncertainty to the potential for systemic risks in a highly interconnected and rapidly evolving financial landscape. As we navigate this uncharted territory, one thing is certain: the evolution of banking is far from over.